Welcome to today's crypto market breakdown. Bitcoin's recent moves have left a lot of people confused. The price keeps climbing, yet many indicators are flashing warning signs. Today we've got a professional AI quantitative trading report, and we're going to break it down in plain English. Can you chase the rally right now? Where's the real entry? How should you set your stop loss? By the end, you'll have a clear game plan. Let's start with the big picture. The AI system classifies Bitcoin's market state as a strong bullish trend, with a trend strength of 0.84, that's extremely high. In plain terms, bulls are firmly in control and the overarching trend is up. In this kind of market, the first rule is, never short against the trend. The trend is your friend, shorting it is like stepping in front of a freight train. But here's the critical twist, the core contradiction of this entire report. The trend is strong, yet risk warnings keep piling up. On the daily chart, RSI sits at 86.2 and the KDJ's J value has hit 102.2, both are deeply overbought. Price is also riding the upper Bollinger Band. Being overbought means the market has run too far, too fast, and it could easily pause or even pull back sharply. Even more telling, the daily market depth analysis flashes a bull trap signal. In simple terms, buying at the current price could be a trap. Price may fake a move higher, then reverse and leave latecomers stuck at the top. So yes, the strong trend is real, but so is the risk of chasing here. Now let's zoom into the smaller time frames. Both the 1-hour and 4-hour charts show a notable warning, strong trend, but shrinking volume. What does that mean? Price is rising, but buying pressure isn't keeping up, like pressing the gas pedal hard while the fuel gauge drops. This bearish divergence often signals weakening momentum, which can lead to a pullback or even a false breakout. One more technical backdrop, the report notes that the one-sided trend detector module wasn't loaded. In a professional workflow, that detector carries the highest priority. Without it, we have to lean more heavily on volume, price action, and market depth. It doesn't change the overall direction, but it does mean we should be more cautious in our decisions. So here's the strategy summary, and this is important. Since the big picture is a strong bullish trend, shorting is off the table. But with overbought conditions and a bull trap warning, blindly chasing the rally is a no-go. The right approach comes down to 4 words: buy the dip. Wait for price to pull back to key support, then enter in the direction of the trend. Better to miss a trade than to make a bad one. So where's the entry? The AI report gives a clear zone, $75,900 to $76,100. That's roughly 2% below the current price. This zone is built on 2 support levels. First, $75,946, the lower Bollinger Band support. Second, $75,588, a recent low. Conservative traders can wait for price to enter this zone, aggressive traders can look at the lower end. But here's the catch, price reaching the zone isn't enough to trigger a buy. The AI report lists 3 conditions that must all be met. First, the 4-hour candle must close inside the zone. Second, clear reversal signals must appear, like a hammer, a bullish engulfing pattern, or RSI turning up from oversold. Third, the taker-buy ratio needs to climb back above 50%. These are your clues that the pullback is over and the rebound is beginning. That's called discipline. Most retail traders lose money not because they get the direction wrong, but because they jump in before the trigger conditions are met. Enter one step too early, and your entry price is worse, your stop is farther, and your risk-reward ratio deteriorates. So remember, entry zone plus reversal signal, both are required. They're the fuse on this entire strategy. Next up, the stop loss. This is your safety net, the most critical piece of any trade. The AI report sets the stop at $75,400. The logic is simple, it must sit below the core support zone. The support below the entry is $75,588, and placing the stop at $75,400 clears out the noise of false breakouts. From a $76,000 entry, the stop is roughly $600 away, about 2.2%, well within risk management limits. Why the emphasis on stops? Because the market is always full of surprises. The report's machine learning model predicts price could drop 2.12% over the next week, targeting $75,821. Notice that this level overlaps almost perfectly with our entry zone. AI also believes a pullback is likely before the next leg up. But what if price doesn't pull back and just breaks down? Your stop loss is your escape pod. AI $78057.